presented material today is for educational purposes only and should not be construed as personalized financial advice. And today we have Frank Fahey on the line with us and to discuss some work he's done with the Greeks. And I'm looking forward to this. I know he's been working hard at this. So, Frank, you're with us, right?
I'm with you. I believe I don't see you right now, but I hear you. I downloaded the software again, and select source, full screen.
Well, on our end, it says that there we go, we can see, it says Inside Wire Meditations on the Greeks.
Well, that looks pretty darn good. If you can see that, I'm going to go with it. And let's see if I can switch. Well, there. Well, here's a hypothetical performance disclaimer. I'm not doing any using my favorite tool, OptionVue, to explain this right now. But I'm going to talk about the Greeks. And gosh, I think the Greeks are the foundation of trading success. It's the foundation of understanding options. And quite frankly, I never understood, or I should say, I never really made money until I started understanding the Greeks. And one thing I find very disconcerting is that when I talk about the Greeks with students, or even people who aren't our students, I'll say, so what do you do? And I'll ask them to describe the Greeks, and they can't go much beyond delta. They'll say, well, I buy it here and I sell it there. And that's all fine and dandy if you do the same thing all the time, but unfortunately, the same thing doesn't work all the time. And as Louis Pasteur said, chance favors the prepared mind. And I need to be prepared to trade. And without being prepared, I can't make a logical or sane decision. And so what is the prepared mind? We'll find it common to, people in high-risk professions. And let's face it, trading can be high risk. And you need to constantly hone your knowledge base. And so here's an example. I trade broken-wing butterflies, and I trade them all the time. But over time, I've had to change my trading strategy. I've had to change my entry points. I've had to change the expiration so that I trade. I had to change the strike prices that I select. And the most important factor in the comparisons has been the Greeks and understanding the Greeks. And knowing the Greeks allows me to recognize and decipher and act across a complex set of conditions. And often, what I look for is the difference that makes a difference. What happens? What if? What if? What if? What if I do this? What if I do that? And it allows me to see opportunities where other people see risk. It also allows me to perform a forensic audit on failures. And that's the tools, OptionVue. And I look at the Greeks because the few Greeks I use reduces everything to a common denominator and what happens to the Greeks. Okay? So they allow me to challenge and test trading decisions and to make informed decisions and reasoned decisions. Quite often, almost always, I know what I'm going to do before I do it. Or I've reduced the adjustments that I have to do. And an adjustment can be closing a position well before I have to make that decision. And part of it is just visualizing the alternate futures. What if, what if, what if? Here's a picture of Frank. Boy, more heavily airbrushed than a gentleman's magazine. Okay, once again, chance only favors only the prepared mind. Here are the basic facts. All option strategies work. And which one do I use? I try to use the same one with the same underlyings all the time. And that's part of building the knowledge base. And I use an option strategy that meets my risk-reward comfort zone. And that's something that we build over time. For example, I'll trade something that Steve would find too risky and vice versa, but it's just how our brain perceives that risk. And one thing that professional risk takers do, and traders specifically, is we start with looking at the risk before we look at the reward. And once we've defined the risk, we will decide, okay, does this reward meet the requirements? And all these different strategies have a set of specific or expected outcomes based on movement in price, movement in volatility, and that is implied volatility. The volatility of the options themselves, not the underlying, and time. And no strategy works all the time. And when the strategies aren't working, I use those Greeks to help me figure out what I'm going to do next. How am I going to tweak it? And then margin requirements are very important. Oh, I don't know how. There we go. Once again, we're back to the complaint I hear from people is, I'll ask them, and they go, well, I don't need to know the Greeks. I trade the same thing all the time. Well, that might make sense if when you trade the same thing all the time, it's in the same price range. Volatility, implied volatility, never changes, and time is a constant. The effect of time is a constant. But none of these things are constants, they're variables. And so we need to know how to react to changes in time. Okay, so why the Greeks? It's the language of options and option traders. On the floor, when we discuss an option, we'd say, okay, what's your delta, what's your gamma, what's your theta, what's your vega? What's the impact of the change in price, change in time, and change in implied volatility upon you, a major position. And it allows us to reduce a position that may have thousands of options and hundreds of thousands of shares of stock to the lowest common denominator. It's a Greek. And it really allows somebody else to understand what you're doing, and it also allows me to compare what I was doing 2 years ago with what I was doing a year ago, 6 months ago, and today. Things change. Okay? Another thing the Greeks allow me to do is allocate profits and losses to changes in different factors. These factors, of course, being a change in price, a change in time, and a change in implied volatility. And the Greeks, gee willikers, the Greeks that allow me to do that are the change in price is delta and gamma. Now, one thing that I do know is most of the people who say they don't need the Greeks do know delta, but they may not know gamma. Theta, they're okay with, and implied volatility is, well, I don't need to know it. I don't hold it long enough. So the longer you hold a position, the more important theta and vega become. Okay, but on a daily basis, I'll sit there and figure out, where did I lose money? Where did I make money? So I might make money on the change in price. I may make money on a change in time. And given the way I trade, if the price went way down, volatility may have gone way up, and I am short Vega. So people will say, well, I got out of the position because I lost too much money. The position moved against me. Well, in my trading style, volatility is an ephemera. It's sort of mean reverting, and it comes back. So when I'm trading a position and my exposure or loss is not due to the change in price, then I know based on my experience I can wait out Vega. And success in trading is based on making good decisions, and that's built on wisdom. Okay, so if anybody has a question, and I know, are you listening, Steve? I believe you are.
Yes.
Just go ahead and ask. Okay, so, and the question, Steve knows this, and I sit there and I go through, use OptionVue 8 to go, what if, what if, what if? What does it look like a week from now? What does it look like a month from now? A position. What does it look like if volatility goes up? What if it goes down? What if price goes up? What if price goes down? And there's certain different combinations of that where I'm constantly paper trading my account or my position, saying, what if this happens? What if that happens? I mean, I quite often say I don't paper trade anything. And that's actually a bold-faced lie, because I'll paper trade if I'm doing a forensic audit, going back and seeing why something didn't work. Where did my discipline break down? And so I paper trade that. That's a what if, what if, what if. I also am constantly paper trading during the day, saying, okay, if we go up, what am I going to do here? So right now, today is, the 18th, and last time I looked, the S&P 500 was, or I should say the E-mini, was trading at 24.55. I actually don't know where it's trading right now. I should be ashamed of myself. But I know, and the reason it's not urgent is I have alert set saying, hey, if we trade 24.25, if we trade 24.40, let Frank know what's going on, okay? And so I know we aren't trading there. Let's see, I can go check right now. I probably should know. 24.55, there's been no change since I started. We've gone down as low as 24.48, as high as 24.60 today. And that's like half a percentage trading range. It's like, So I don't worry too much, but I know what I'm going to do at 24.45. I know what I'm going to do at 24.35. And I know then I will make adjustments at that point. So the upside is benign, so I can sit here and not worry too much about that. So, come on. Starting point's an option pricing model. And I know people say, oh, Frank, come on. Do we really have to know that? No. Well, but you need to know what are the differences that make a difference in that. And so there's a number of variables, as I mentioned before, that affect the price. The variable affects the options price model. And changes in any of these variables will create changes in the option prices. And I use this model as the basis of all my decisions, okay? And so, boy, come on. There. And implied volatility, of course, is calculated from the model. One thing I do know is a lack of understanding of the Greeks will cost you money. And where it costs you money is when it goes, the trading day goes outside of what we would call the normal range. Remember I said we've had a range of 24.48 to 2460 on the E-minis today. Well, that's not a range big enough to where it's a difference that makes a difference. Okay, but I know my Greeks at any point. I could tell you my Greeks off the top of my head, tell you what my delta position is, what my gamma position is, and vega and theta up and down 50 points. It's something I know. And so the option pricing model, all you need to know is what are the variables that go into it. You don't need to know this, okay? And I know quite often people, you guys will look at it and say, oh gosh, I don't need to know this. About the only thing you need to know are the variables that go in, and know a good tool which translates this into the lowest common denominator. One of the best tools I've ever found, and I've been using trading tools since, gosh, the mid-1980s, is OptionVue. It's more bang for the buck than anything else I know. I guarantee that with the right tool, you can justify a year's investment in OptionVue on avoiding one error. And trust me, I catch myself on errors many times a week, if not a day, because of OptionVue. I tend to move very, very quickly. And I don't need to worry about this. Now, one thing to know is there's many different option pricing models. And even OptionVue will give you the choice. Do you want to use the Yates model? Do you want to use Black-Scholes? Do you want to use Cox-Rubinstein? I use the same model all the time. Sometimes it doesn't matter, depending on what you trade, what you use. Now, I use the Yates model, and Yates has done a very good job of developing a pricing model that works in today's options environment. I use that all the time. I know people that switch from different pricing models because, well, it looks better, Frank. And it's sort of like, no, I want a constant as far as the pricing model, and so that I understand how things work in my world, in Frank's world. So let's look at it. Here are the inputs. We have price, okay? Volatility, time, the strike price, the interest rate, and dividends, okay? Well, there's things that we do know what the price is, how long it is until expiration, which is time, the strike price, and we'll call it 50. The interest rate, that's the risk-free interest rate. A lot of people use a T-bill on that. And dividends if it's an equity. So we know that. Okay, on all of these, Black-Scholes, Cox-Rubinstein, Yates, they'll use this information to calculate the implied volatility. And the reason it's implied volatility is, if you look, we have these 6 things up at the top, which is the theoretical way to do it, okay? And you come up with a fair price, an option fair value. Well, we know what the option price is through the auction marketplace. So I'll look at this and I'll say, okay, I know all these things except for the implied volatility. And OptionVue will calculate that implied volatility and help us make those decisions. So if I know the price, the implied volatility, all this information, I'll know what, it gives me the Greeks. Delta, gamma, theta, vega, and rho. Now you'll notice I haven't said anything about rho. Rho is the sensitivity of options or option pricing to changes in interest rate. When I first started trading, the interest rate, if I borrowed money, I paid broker loan plus 1%. Broker loan was, gosh, at one point when I was trading, 13%. So I pay 14%. to borrow money. I generally had to borrow money if I bought stock. I got 80% of broker loan for credit balances in my account or short stock. So that was 0.8 times 14 is 80 plus 3.2 is 11.2%. Now, our clearing firms made the spread between, I lent them money at 11.2 and they lent me money at 14. There's a profit in there somewhere. But what's important for us to know, and at any point, know delta, gamma, theta, vega. And the way you start ingraining that in your brain is doing the what-ifs with the tools in OptionVue. What if I do this? What if I do that? What if the price goes up to here? How much do I make? Now, one thing I'd like to do is with the graphs, it shows me dollar risk or dollar reward. I make all decisions on dollar risk or reward. I do not allow myself to be, I don't look at a percentage rate of return. If I take care of the dollars, the percentage rate of return will take care of itself. Percentage merely masks what's really happening. I can't spend percentage anywhere. I can spend dollars. So let's go over, this is an overview. Delta, all these Greeks are sensitivity. Delta is movement, sensitivity to movement of the price of the underlying. Okay? Gamma is sensitivity to the movement of delta. It's going to tell you how fast delta is going to move when the price goes up or down. A good way to look at that is that it's acceleration. How quickly is it going to move? And so when I worry about price of the underlying, what's happening down price of the underlying, that's delta and gamma. That's the first thing we all lose. Theta is how much I either get or pay to have a position. Options, and that's calculated on a daily basis. Options are a wasting asset. So if I'm short option dollars, meaning I've sold the options, net sold them, then that wasting asset works to my advantage, and I have a positive theta. Okay, that's the sensitivity to time. If I own something, own a straddle or something, I have to pay. I'm losing a little of the juice every day because I am paying for the opportunity to have movement. And then Vegas had sensitivity to implied volatility. In all honesty, I never really had a clue what I was doing until I understood Vega. And it took the crash of 1987. So I had been trading for 2 years. And understand that when I was first trading, I got my Greeks in the morning. I got delta, gamma, and theta. We didn't even get the Vega number. And I would get them at the beginning of the day, and I would have to calculate with a calculator, a pen, and a trading card and a pencil what my delta was at different points in the day. I got to be pretty good at estimating what my delta was. Right now, with OptionVue, I have software that's the equivalent of what Goldman Sachs had in the 90s. Okay? It's better than anything I ever had as a market maker, and I traded through on the floor in different exchanges through 2007. And so, I mean, it's a superb product, and it allows me to know what my risk is. So all these may provide a sensitivity to the movement of the underlying, but they also allow me to assess my risk via a number and also via a graphic representation. Okay? And so experienced traders control risk. These numbers here, the delta, gamma, theta, vega, and rho, and I still look at rho because I'm an old dog. But the four are important. And, delta and gamma is movement in the price of the underlying. Theta is change in time, okay? And time is expiration. How much is coming in or going out on a daily basis? Boy, I have a very wonky position. I'm sorry about the flickering there. And then vega is a change in implied volatility. And so generally when a stock goes down, implied volatility goes up. When a stock goes up, implied volatility goes down. Now, if the underlying's grains, wheat or corn, when the price of corn goes up, volatility goes up. And you start learning that. This is where the Greeks are important. How do the options behave when the price of the underlying goes up or down? And so, and I mentioned this before, experienced traders control risk. Inexperienced traders chase gain. And so, first I look at, the risk. I think Jay Giles once said, first I look at the purse. Actually, it was the contours who were on Motown, but everybody we grew up in an era where quite often it was the white guy that got the credit, who got the airtime. But first I look at the risk. First I look at the purse. I don't look at what the gains are. I don't, If I do everything right, if I control the losses, then when the gains come, they'll take care of themselves. And I mentioned that. I look at dollar risk. I look at dollar reward. Okay? I don't look at percentage. Okay? So, important thing here is there's a zen of trading. Balancing patience and panic. The knowledge of the Greeks will, by definition, reduce the amount of panic in the trading day. Another way of defining trading is it's long periods of boredom interrupted by moments of panic. And knowledge reduces the level of panic. It increases the likelihood that we will make an informed decision. Back to the prepared mind. The prepared mind is that Zen attitude that allows us to optimize patience versus panic. And so the Greeks are going to allow you to build your own guidelines. For example, I have some pretty big positions, and one of my biggest criteria is when vega gets too high. I control delta, I control gamma. I'm always looking at theta, and then all of a sudden I'll look at, minus 17,000 vega, and it'll be like, oh my gosh, if we collapse here, even though I know that vega is an ephemeral, an ephemera, it's short-lived, it'll revert to the mean. I quite frankly can't avoid or stomach a big move in volatility and multiplying 5 or 6 points times 17, 18,000 in vega. I have a limit where, and it's probably my biggest one, is controlling the vega, to where it's at a manageable level. And it's one of those things that creeps up on me over time. And so I watch all the Greeks. I realize all trades are adjustments, whether it's an opening trade or a trade, what we would call an actual adjustment. Closing a trade is an adjustment. Tweaking a trade is an adjustment. Well, all of those are what ifs to me. What if I do this? Should I buy some of this? Should I sell some of that? Should I make the position smaller? Can I add to the position? I mean, these are decisions I make all the time. And I don't put on one trade at once, a big trade at once, and take it all off at once. I walk into risk and I walk away from risk. It's a constant exercise in what if, what if, what if. And quite frankly, I can't make the decision without the tools, and that tool being OptionVue. And I can't make that decision without knowing what my Greeks are and a reasonable graphic representation of what it looks like. And OptionVue provides all those things. And so here, adjustments. What do? They look forward. Once again, we're down to changes in price, change in implied volatility of the options, and time. And I have an idea of what I think the range will be for implied volatility and for price. That's defining limits on the risk. Okay, I'm looking forward. I adjust a position. I create a position that takes that into account. And I don't dive straight in. I mean, it's sort of like one of the first things they teach you about diving is that know how deep the water is that you're diving into. And they tell you to as they say, test the waters. And my trading style is a ongoing activity of testing the waters, which is what if, what if. Am I going to break my neck if I dive in this time? It's a constant exercise for me. So, and here's I have other factors beyond the Greeks, you know. What's the underlying? Is it an equity? Is it an index? Is it a physical future, a hard future, a soft future, an ETF, an index? What's the strategy? Now, one thing you'll notice in different strategies, they have different constants or characteristics as far as the Greeks associated with it. If you short a vertical, you'll find that most of the time the Greeks from one short vertical to another, to another, to another will have a certain consistency in behavior. I always look at market sentiment, bullish, bearish, neutral. And neutral would be, I call range bound. A time window, you know, days, weeks, months. That's theta. You know, how I look at the theta, how I look at the movement in implied volatility. Implied volatility 3 months out is not going to move as dramatically as implied volatility this week, okay? And then just to add to the decision-making process, I always look at liquidity. That's, you know, option volume and open interest. And as a basis of that, how wide the spread is between bid and ask. If I trade something, I want to be able to get in. I want to be able to get out at a fair price. I don't want to have to be put in the position that I trade somebody where it's trading, as we used to call it on the floor. You know, you'd ask somebody about, how's this options, the option markets here, and they'd say, well, it's trading by invitation, meaning that they'll let you in when they want to let you in, and they'll let you out when they want to let you out. And there's very few things that are worse than being right on the direction or your scenario for a specific stock is pretty constant, and not being able to get out. And dollar risk reward, once again, I can't emphasize that enough. You know, as we used to say, the greedy get needy. So a better way to put that might be an achievable dollar risk reward. And that's something you learn over time. It's part of the wisdom we come up with. And that's what I mean by goal, achievable goals. And finally, something that to print out, to put on your wall. And I have this on my wall. I had it on my wall. I had to track it down. It took me quite a while to track it down again. It was on a backup that was probably about 6 years old. This is what calls and puts do when we have changes in the stock price, in the different factors that are the different Greeks, okay? So, and you'll notice here we have dividends, strike price, interest rate. These are factors in the variables in the options pricing model. This is something that Steve and I did this, created this in 2008, actually before the crash, before we went to Prague. And this is something we did. And it's something I still look at. I mean, I'll do there. And where it gets, and you'll learn over time, as you look at the Greeks, you're going to go, okay, as the price goes up, okay, what happens to my vega, or what happens to my theta? And you're going to start realizing that these are interrelated. And the important things here are delta, vega, and theta. And delta and gamma are together. It's vega and volatility and theta and time. But these are very important things where you can just glance at it and go, okay, this is what's going to happen. And it's something I still look at, and I've been trading this on a daily basis for over 30 years. Okay, so in conclusion, know your position. And when I say know your position, know what the strike prices are, know where your months are, and know what the graph looks like. A lot of people really don't quite understand what the graph looks like. And know the Greeks associated with that position. It drives me batty when somebody calls up and they go, I have a position, I have some questions about it, and I'll say, well, what is it? Well, let me look. It can be a position with two legs. You're long a call, you're short a call. Come on, know it. It's sort of like, well, I have a date tonight. Well, who are you going out with? Well, I'm not really sure, but I'll recognize her when I see her. Come on. And of course, I hit this again, but know your position. Understand the impact of changes in price and implied volatility on your position. And the reason I didn't throw in time is the one risk I look at is I look at today's risk. Okay? That's what I'm worried about. And that's a function of being a market maker for as long as I was. Will I be in business tomorrow? And one thing I do is I will always buy a cheap call to the upside on almost any short position. I sell a second fly to the downside. That's something I do when I'm trading broken wing butterflies. I will remove this from future presentations on this. And know in advance what your responses will be to price movement and the underlying. So, thanks, guys. Do we have any questions? Hello. Let's see. I'm going to have to figure out how to the question area.
Yeah, it's the chat area, Frank. You see that? On the right?
Oh, I had a big screen going here.
Well, then I'll just how about if I just recite it? How about that? Would that work?
That's even better.
Oh, I know. Hey, Frank, so go to the chat. Do you see on the, click, go to
there,
the right.
I see chat. Okay, Brian.
Boom,
okay,
there.
I see that. Hi, Brian. Brian wanted to know if I look at True Vega. I don't have access to True Vega. I look at just regular Vega. understand that I've been looking at some of these for 30 years that I know, and I trade the same thing all the time. So given that I trade the same thing all the time, the same underlying, I use the same basic approaches. When I say basic approaches, either selling volatility, which is selling premium, or buying premium. I have a tendency to know the holes in anybody else's model. So I'll know that if we go up, the position and volatility goes down, the position or the model tends to have underestimate the impact of volatility on my profit and loss, meaning I'll make more to the upside. And then generally I'll lose a little more to the downside than the graph might show me. But I know that. And that's because I traded it again and again and again, and it's part of my trading DNA. And so are we going to be offering True Vega, Steve?
Well, Frank, let me introduce this idea, because OptionVue does have CEV, the constant elasticity of volatility, and so OptionVue is taking a stab at predicting where volatility is going to shift when the underlying moves a certain direction. Okay, and so that CEV is factored into the Greeks, and so like we know about True Delta, for example, right? So now that we have, right. and we do have then CEV is calculated for different time frames, and so given that, would that be considered then True Vega? I mean, that's one of the questions, is that would that constitute True Vega if you have CEV in different time frames?
I think it would.
30, 60, 90, 1 year, 2 year CEV figures. And, so does that constitute True Vega? I mean, I would think that would. Now, Brian.
And it also raises the question, can you really get True Vega? Meaning, I'm trading the S&P 500 or a derivative of the S&P 500, and we've had an ongoing collapse in volatility over time. So what happens is, I know that given in this environment, since Vega's looking forward based on the past, I think OptionVue does a very good job on it. But for that reason, I know that it sort of underestimates, because every time we go up, volatility goes down just a bit more. I mean, we have 4 straight years of volatility going down, and once a month I'm talking about new all-time lows on volatility, or the VIX, or VIX derivatives, which are based on the implied volatility. So yeah, I'd say CEV does a very nice job. It's better than any of the alternatives provided by trading platforms that I use.
Brian said that True Vega is different from CEV. And he's typing a lot, so you get another explanation.
Okay, well,
True Vega is a separate
I can
concept.
see it. I'm also, as the market maker mentality is to reduce things to a lowest common denominator, so I tend not to let it get too complicated for me. I like to filter out the background noise, so this is, and it drives my wife crazy, because there's a behavior characteristic where I estimate, and I'm very good at estimating numbers. But generally, if I do much more than an estimate, then I run into the paralysis by analysis. And so I'm wary of that. On balance, having used OptionVue for, 9 years and watch how Len has modified it, and interacting with other professional traders here in town. OptionVue is, quite frankly, is good or better than the other alternatives that attempt the price. I'm stunned what people play at times, and very happy with the product I have. I didn't really mean this to be a commercial for OptionVue, but it should be, because the Greeks are only as good as the tool that you use to provide the Greeks. And on a real-time basis, and as far as my ability to modify it, it's more than good enough for me. You know, it provides those lowest common denominators that don't allow me to stress out and make rational decisions. So.
Yeah, Brian, I'll look into that.
Let's see what.
Yeah, he's just asking if we could get a true Vega calculation. Yeah, that'd be fine.
I would love it. If we have it, it's another thing, because once again, it is a synthesis of many complex things. So when people say, "Well, that's not exactly right," boy, it's pretty close to what we need to do. You know, it's an information that allows people like Brian and myself to get rid of that background noise and be able to make decisions based on something that's quite reasonable. And at times, I don't need a whole lot of stuff to make my decision. Okay. I mean, and our graphs, OptionVue has the best graphs of anybody out there, and it's true that a picture's worth 1,000 words. And here I am, I'm a math major in college, and I look at the pictures. So,
you know, Frank, I'm going to have to get going here. I have another webinar beginning in 2 minutes.
Okay, so am I.
So, folks, thanks for joining us. If you're, Brian, thanks so much for being with us, Brian. I really appreciate it. And everyone watching the recording, thank you for listening. And we'll be back next week with another topic. Thanks so much. Take care. Bye-bye, everyone.
Okay, bye.